There are several vocabulary words. These are terms associated with engineering economics that are essential to engineering business practices and systems engineering. So I'm going to take a minute to explain these terms so that you, as a student in systems engineering or engineering business practices, can write them down and commit them to memory. As you practice with problems and you work through reports, you will gain a deeper appreciation of what the terms mean. But for right now, these are the descriptions that you need to know. The first term is interest rate, and it is communicated in units of percent per time. For example, percent per year, percent per month, percent per day. That unit of time is essential. It's often overlooked. And if it is overlooked, then you assume that the interest rate is per year. But don't make the mistake of forgetting the unit of time. Interest is the rent you pay to use other people's money. Rent, you're probably familiar. You rent a car and you spend so much money per day to use somebody else's car. You rent an apartment, you spend so much money per day to use somebody else's home. You rent a hotel room, you spend so much money per night to stay in the hotel. When you're using someone else's property, you rent it. But when it comes to money, if you're going to rent someone else's money, the term that we use is interest. And the amount of rent you pay is proportional to the amount of money that you've borrowed. So if you're going to borrow $100 and spend, say, $10 per month to rent it, you're paying $10 divided by 100, 10% per month, which is an extraordinary, usurious rate of interest. Interest is the rent you pay to use other people's money. That's from the perspective of the borrower. There's another way of thinking about interest from the perspective of the lender. You could say interest is the rent you collect to allow other people to use your money. And it's true. But perhaps a better way of thinking about it is that interest is what the bank or the investor or the borrower pays you for the privilege of using their money, which is the same thing. But calculating it is a little bit complicated. When you have lent an amount of money, typically called the principal, and you want to calculate how much interest you're going to collect over time, you apply the interest rate, in the previous example, 10% per month, and multiply it by the principal or the balance, the amount lent. So 100 times 10% per month would yield 10% interest per month. That's the rent that you pay or that you collect as a lender. Now you want to know how much would that balance that you've invested or that you've lent be worth after a year. At 10% per month, you need to account for what's called compounding. That rate of interest is so large that it matters how often you collect the rent. For example, in the first month, the 10% times 100 yields a balance of 110. Now the principal goes up. That is, the amount that the borrower owes you has gone up from 100 to 110. Unless you were to withdraw the $10 of interest, your balance has increased to 110. And in the next month, you get 10% of 110, and that results in 121. This is the effect of compounding. After 12 compounding periods, and this is another important vocabulary term, compounding period. After 12 of those monthly compounding periods, the balance in your account is going to be 100 times 1 plus the interest rate. That is 1 plus the 0.1 raised, all the quantity raised to 12. So what does this mean? If I take 1.1 and raise it to the 12th power, remember how I said 10% per month is a usurious, it is an exorbitant interest rate. 1.1 raised to the 12th power is 3.13. If you were able to invest or to lend your $100 to a borrower capable of paying 10% per month, and instead of paying you the rent every month, they compounded the balance so that it grows. And then the next month, they owed you 10% of the principal plus the rent from the previous month, the interest that was added to that principal. At the end of the year, they would owe you $313 because 1.1 raised to the 12th power is 3.13. So now we have two vocabulary terms described. The first is interest rate, the rent you pay to use other people's money, or from the perspective of the lender, the amount of money you collect because you have invested or lent or allowed other people to use your money. And compounding period, how often that rent gets either paid or added to the balance of the amount of money invested, lent, borrowed, used. We got to understand a few more terms. And the next one is discount rate. Discount rate is expressed in the exact same units as interest rate, and the two terms often are used indistinguishably. But a discount rate is not the amount paid to use another person's property. Discount rate is used when you're imagining some future amount of money, some future promise, some future expectation, and you want to calculate the present value of that future promise today. Amounts of money in the future aren't worth the same amount as they are today. A discount rate is what you use to calculate the present value, which is another vocabulary term, the present value of some future promise. So let's think about this backwards. If you were expecting a promise of $313 a year from now, and you wanted to know what is the value of that today, you would reverse the interest equation. You'd say, well, I need to apply a discount rate. And a discount rate is not necessarily how much rent will be paid. It is your time preference. That is, it is an expression in percent per unit time of how much you value the money today compared to getting the money a year from now. There are at least 3 different ways to determine that percent per year discount rate. Discount rate is when you're moving money, computing an equivalence of a future amount to the present. So you're moving money from the future backwards in time to a near-term date. Interest we use for moving from the present to the future. Discount we move from the future back to the present or to the past. So the $313 today, if you're going to say, well, my time preference is 10% per month, because that's how much interest I think I could earn on some alternative investment, then you're determining your discount rate using opportunity costs. What else could I do with my money if I didn't lend it, allow someone else to use it in exchange for a promise to pay me more a year from now? But there are a couple other different ways. Another way is risk. You might apply a high discount rate to those promises you think are very risky, because maybe that person isn't going to be around in a year to pay you back, or maybe they don't have the money. A third way to think about it is just plain old subjective time preferences. How do you feel about it? And your feelings might include whatever forecast or anticipation you have for inflation, which is another vocabulary term that we need to describe. So let's review. Interest rate is when you're moving money forward in time. It is the rent paid to use another person's property, in this case, their money. It's in percent per year, just like discount rate. But discount rate is when you're computing equivalences of money in the present that are expected in the future. They both are expressed in percent per year. Compounding period is the amount of time between the rent payments, or the addition of interest onto the balance that is borrowed or lent. In the case of discount rate, there's also a compounding period. When you think about it's either per month or per year, it's less important than in terms of interest, because a discount rate is not the same thing as a promise to pay. It is used to compute an equivalence. Mathematically, it's the exact same equations. So we've gone over interest rate, discount rate, compounding period. We also need to understand present worth. A future promise is not typically worth as much in the present. When you compute the equivalence in the present of some future promise, we call that a present worth, and we need to describe inflation. All prices are expressed as ratios: dollars per unit, dollars per gallon, dollars per day, dollars per mile, dollars per something or other. Inflation is often understood as a general overall increase in the level of prices. And what that means is a dollar will not buy in the future the same amount of miles or gallons or days or nights or hamburgers as it buys today. So another way of thinking about it is an overall decline in the purchasing power of the currency, in this case, the dollar. And it's one of the reasons that we typically discount future promises to compute a present worth. So inflation is generally understood as an overall increase in the level of prices. We have a few more terms, but we're doing pretty well. One of them is internal rate of return. When you're contemplating a project in civil engineering, typically the amount you have to pay is upfront. There are a lot of design costs, construction costs, and the benefits come in the future. And it might be spread out over 50 years or 100 years. So you're expecting the dam to provide flood protection and irrigation water and hydroelectric power. The dam could cost you millions, hundreds of millions today, which the project would only recoup in the future. And all of those future expectations of benefits, they must be discounted to the present day to understand whether the project is financially viable. An internal rate of return is that discount rate expressed in percent per year that will equate the present value of the design and the construction costs and all the upfront costs with the discounted stream of expected benefits in the future. So there is a discount rate when you have on one side of the equation the upfront costs, and on the other side of the equation the discounted present value of all the future benefits. There will be one discount rate that equates these two. It's not likely to be 10% per month. Maybe it's 20% per year, 10% per year. That discount rate at which the present value of benefits is equal to the discounted present value of the future expectations. I said that wrong. The present value of the costs is equal to the discounted future value of expected benefits. That discount rate is called the internal rate of return of the project. There's one more, the minimum acceptable rate of return. You might have a standard in your mind for your civil engineering projects, and you say, we will not fund any project with an internal rate of return less than, I'm going to make up a number, 22%, 25% per year. That would be your minimum acceptable rate of return. And many corporations will have in their minds or in their policies that sort of threshold, a minimum acceptable rate of return at which they will not fund a capital investment. Maybe it's a plant expansion, maybe it's a upgrade to their physical plant, and they'll compute what are the costs, what are the future expected benefits. If we're going to replace our data servers, we ought to be able to compute an internal rate of return. If that internal rate of return does not exceed the minimum acceptable rate of return established by the company's financial policies or investment strategy, then the project is a no-go. We've gone over interest rate, discount rate, inflation, internal rate of return, compounding period, present worth, and minimum acceptable rate of return. Now it's up to you to summarize your understanding of each one of these terms for yourself so that when they come up later in our conversations and in our problem statements, you have a better recall of what each term means.